Clayton. Derek Felske, our Chief Investment Officer at Annex Wealth Management. Good morning.
Good morning, Danny.
Hey, Deanne Phillips, Director of Client Learning Development, a CFP and a CDFA at Annex Wealth Management.
Hello, Danny. So, Derek, interesting week. One of the indicators that we watch is that fear and greed indicator. It's sitting at neutral in terms of sentiment. However, we all saw the S&P, of course, touch new highs this week.
Oh, we did. The fear and greed index as a whole is neutral. It is 7 elements. The 2 elements that are at extreme greed are probably the 2 that I watch the most, which is put-call ratios and corporate credit spreads. Both are at extreme levels. Suggests that one needs to be somewhat cautious considering further market advances. But basically, this was a week in which interest rates surprised people. The 10-year Treasury yield dropped 10 basis points to 1.45%, despite the fact that we had a very hot CPI number. And what that did is fueled a rotation back towards growth stocks, towards the NASDAQ and small cap stocks, which significantly outperformed the S&P 500, which finished roughly flat.
Yeah, can we talk about that CPI for a moment? Because certainly as consumers, we're starting to feel that ancillary inflation everywhere around us.
Well, we are. If you look at the number, it was the highest year-over-year increase since 2008. We know we're going against a very low base level from last year when the economy was partly shut down. And when you break it down by category, nearly 2/3 of the overall increase stemmed from fuel, used cars, and contact services. So not something you need to be concerned about in the long run, provided that these upward pressures prove transitory.
Can we dig deeper into the headlines? Sometimes we think, which one, stocks or bonds, but you showed me some interesting market trends earlier this week on the indices.
Well, the thing about the markets is they discount the future. And I think when people look at the headlines, they get frustrated because they hear about a high CPI number and they expect the market to do something, or they hear about a great GDP forecast or a great earnings release from a company. But at this juncture, we're actually well into a market advance. Over the last 12 months, the S&P is up 40%. Small caps are up 73%. Developed Europe 43%. The ag bond flat, but other areas of fixed income have done much better, like preferred stocks up 16% and high yield up 12%. But on a year-to-date basis, we also have gained as well. S&P up 13%, mid caps 19%. My point here simply is the market has discounted a lot of good news. So when you hear about a great GDP in the second quarter or great corporate earnings in the second quarter, don't just think you need to run out and add equity exposure. A lot of that has probably already been priced in. So now is a really good time to do what you and all of the wealth managers at Annex suggest: reassess your holdings, rebalance, and look for other opportunities.
Right. And we certainly are still seeing supply chain issues. How are those impacting commodities, and how does China fit into this?
Well, China fits in because essentially their prices have been skyrocketing. Their producer price index was up 9% in May, its fastest in nearly 13 years. And the Chinese have a different form of government than we do, a different setup than we do, and they're basically requiring suppliers to keep prices under wraps. In the United States, we don't quite do it that way. But generally speaking, a lot of the spike in commodity prices has ameliorated itself somewhat. Lumber prices have corrected pretty substantially. Copper prices have pulled back a little bit, but they're still way up from where they were a year ago.
Oh, they were. I have clients come in all the time and they talk about projects, home improvement projects that had to stop because of the price that have gone through the roof.
Right. One of the reasons the housing numbers haven't been, the new home construction numbers haven't been as strong, as a lot of contractors are just, either the potential client is rescinding their order or they are pulling back because they feel that the cost of components is just too high. The cost of lumber, the cost of all the other raw materials that go into home construction are just too high. And frankly, they sometimes can't even get them.
Right. But the consumer still has a lot of liquidity. We are seeing that.
Well, they have a ton of liquidity. So do the banks. We know that the banks are actually turning back cash. They're actually suggesting to corporations that they go elsewhere with their money. So again, this is one of the backdrops of the market that is positive. We have an ample liquidity, record levels, $2 trillion in corporate balance sheets. Consumer net worth is at an all-time high. So the economy is in great shape. The question is, has that already been fully reflected in prices? And at 21 times forward earnings, we need companies to continue to beat expectations going forward.
I think this is why it's really important to be thoughtful with rebalancing in portfolios.